Hey guys, welcome back. In today's episode, I want to talk about dividend investing during a recession and update you on my portfolio. As you can see, my portfolio is currently sitting at $99,000. I hope to soon break through the 100K mark. My asset allocation remains at 73% stocks, 16% bond, and 11% cash. You can review all my portfolio holdings here on this page. I will continue to look for good value and dislocation in stock prices, especially if we see another sell-off. With all the mega caps reporting this week, there might be an opportunity and we see larger moves in the market. I plan to add more companies that should perform well with this new normal lifestyle that we have. Just subscribe to my channel to get updates on my portfolio and all things investing. From a sector allocation perspective, I'm still overweight technology, but this is working out well so far. I plan to add some biotech stocks as part of my healthcare allocation going forward. So let's jump into dividend investing during recession and let's look at potential implications and advantages. This year, market volatility has returned back to the stock market in a big way. Market moves of 3% daily are now fairly common. The headlines are filled with so-called market experts talking about a new era of depressed long-term prices and that unlike past temporary pullbacks, this time it's different. Dividends have historically been an important component of the equity total return. As we can see in this chart, dividends account for nearly half of the S&P 500 returns. But now, given the pressure of the pandemic-related economic slowdown, companies looking for ways to conserve cash flow are targeting dividend payments. The number of companies that have announced a cut or suspension of dividends is now the highest level since the global financial crisis. While the comparison of the financial crisis may make for a good headline, there are important distinctions to bear in mind. Most important is that unlike in 2008, which was largely focused on one sector of the economy has been shut down completely due to the virus. Many companies that were otherwise assumed to be strong had to reassess their financial situations. The impact is particularly severe in industries such as travel and leisure, but by force of the shutdown, it's not surprising to see a number of announced cuts and suspensions. I expect to see further dividend cuts and suspension announcements during the upcoming earnings season. In particular, companies with higher leverage or those that have been funding their dividends through means other than high cash flow. While some companies use the dividend policy to reward investors for participating in the company's growth, others use the policy to support the stock price because the earning growth is insufficient. It's these latter companies that are now under greater pressure to cut or suspend dividends as a way to conserve cash. In certain cases, companies accepting federal aid as part of the CARES Act will have no choice but to cut or suspend the dividend due to the conditions of the program. Dividend cut levels will likely approach and may exceed the global financial crisis era, led by cuts in energy and certain consumer areas. The big banks, which were in the epicenter of the 2008 crisis, have entered this crisis in a relatively strong position. I don't expect a raft of cuts here, but will continue to monitor the situation. I believe that it's critical for investors to remain focused on the longer-term performance of dividend stocks. Over the long term, companies that pay and grow dividends have outperformed the S&P 500 annual average. And looking at the last three recessions, dividend payers and growers in the S&P 500 were able to outperform non-dividend stocks as well as the index overall. This is an unusual environment. Even healthy companies are being pressured to cut or suspend dividend payments. Intense research is important to uncover opportunities for long-term investors. This means focusing on companies with high free cash flow and healthy balance sheets. These companies may be more likely to successfully weather a recession without having to cut dividend payments. As always, I advise against chasing the highest yielding stocks. Yield for the sake of yield is typically not a good investment strategy. Stocks that are higher yielding, but without underlying earnings growth to support the dividend, may be more likely see a cut or suspension. The COVID-19 crisis taught me that such an investment criteria isn't sufficient. I need to consider whether the customers and clients are more willing and able to pay for these goods and services. Market volatility can be nerve-wracking for most investors. Stock market drops like what we've witnessed in the last few months can often convince people to run for the hills and exit the stock market. But in times like that, it's worth remembering that stock market correction, both short and deep, are normal and healthy part of the stock market. They help to shake out weak hands and speculators. Long-term dividend investors will be rewarded for their patience. Again, thanks for watching. Please subscribe to the channel, and I see you on the next episode.